Good morning, everyone, and welcome to the Nedgroup Investments Quarterly Roundup. It's been an interesting quarter for sure, with solid returns for the quarter, which made the year-to-date returns very good as well. Also, it's been very interesting with all the central bank action, tariff policy news, geopolitical drama, and so on, and of course, emerging markets and gold producing very good returns for investors. So I'm very pleased to welcome our first guest for today, Rashaad Tayob. Rashaad, welcome. Rashaad is a portfolio manager at Ford Asset Management. Ford managed the Nedgroup Investments Stable Fund for us. Rashaad, nice to have you here.
Good to be here.
Great. Rashaad, just very recently we recorded a podcast on our recent research trip to Asia, which I was very privileged to be able to join you and your colleagues on. So that just came out recently, so our viewers can look out for that. I think it's a nice, interesting take on what we experienced there in China. So Rashaad, firstly, I guess just from a performance perspective, so year to date, the fund has put on some very good numbers on the board. Do you want to talk us through that and some of the longer term numbers as well, please?
Yeah, so if we look at the last year, we've done well relative to the CPI benchmark and relative to peers, and that's coming through in terms of the 3 and 5 year numbers as well. So our goal is to deliver the CPI plus 4 benchmark, but also control the downside risk. And if you look at the history of the fund, especially over the last year, we did have a big sell-off in April, which I think sounds like a distant memory, but there was that tariff sell-off. But because the markets recovered quite quickly, I think generally investors weren't negatively impacted, but we did well to protect capital during that period as well. So if we look at the performance, you mentioned how well emerging markets has done, how well gold has done, and that's definitely contributed to the performance of the fund. If you look at I think we've generated returns from a range of asset classes. Domestic equities, domestic fixed income, including bonds, have delivered a strong performance. But foreign assets were the biggest driver. And I think one of the benefits we're seeing is if we look at the last 2 years, the US exceptionalism story, it was the only game in town. But this year, you have seen performance come through from non-US equities, non-US assets, and that driven by the weakness of the dollar. The flow out of America has helped broaden the market. It's not as concentrated as before. And our funds are definitely benefiting from that, both on emerging market and developed market equities being a big driver, as they are quite a significant holding in the fund.
I like that you mentioned about the diversified aspect of the portfolio. It's something which you definitely place a lot of emphasis on, and the fact that there are many sources of return, which deliver performance. Interesting as well, I remember you were talking about gold at $3,000, it seems like a long time ago. We've just gone through 4,000 now. And I saw something about Goldman Sachs predicting almost $5,000 an ounce.
We've got a chart on gold later. Maybe we can discuss it. But you're right, the move from 3 to 4,000, I think, has, even for us who've had a long-standing position, it's taken us by surprise, the speed.
Yeah. And Rashaad, I guess the other one I wanted to ask you about was just kind of exposure to kind of the big US kind of tech companies as well, something which a lot of investors are putting a lot of bets on. What are your thoughts on that versus potentially other countries that you can rather invest in outside of the US?
Yeah, so as mentioned, the 2 years, it has been difficult because it was really a very narrow market, and it's broadened out nicely this year. What we have been saying, and was borne out over the course of this year, but the valuation differentials had become quite stretched. So when you look at the S&P versus a lot of countries, including South Africa, and over here we've got a chart of the PE of the S&P in the 20s in white, and the PE of the Hong Kong index in yellow, and you can see that you're basically trading at less than half the multiple. So we felt that the valuation gap had just opened up too wide, and there was a potential definitely for the cheaper markets with good growth to start coming through. And we have seen that over the course of this year. S&P has given you 14%, and Hong Kong has really performed nicely with a return of 39%. So that we definitely think there's still a place for focusing on valuation, especially where the cheaper stocks are actually in some cases delivering better growth and better earnings growth. That combination of cheapness and better earnings growth has definitely come through over the course of this year in terms of performance.
I see you mentioned about strong fundamentals on the chart there. Do you want to elaborate a bit more about that? It's quite an interesting point.
Yeah, so a lot of our we've we've got a reasonable amount of Asian exposure, and especially exposure to some of the big Chinese tech names, which were trading at single-digit PEs. But in terms of their earnings growth, were coming through at even better earnings growth at some of the Mag 7 stocks. So when you have that combination of the better earnings growth and the better starting position, I think the market took a while to really understand that, and you needed a bit of macro, you needed some of that tariff weakness, a bit of the move out of the dollar to really open people's eyes and say we need to look outside the Mag 7, outside the S&P 500. And once they started doing that this year, you really saw the money start to flow and the performance of non-US equities start to come through.
It's interesting how the market eventually recognizes
Cottons
these
onto it,
things.
yeah.
Rashaad, maybe just changing tack a little bit, just to look at kind of your ILB exposure, which I think if you look at yields from a market pricing perspective, pretty much the highest it's been since ILBs were first issued, right, like 20, 25 years ago. So, what's your take on that? I know it's a position which you've started building on in the portfolio from, what's it, almost a year now or so?
Yeah.
So yeah, what do you say about that and what the market is giving you?
Yeah, so inflation-linked bonds are a relatively newer asset class. They've been around since maybe the 80s in the UK, but generally markets in the US, late 90s, early 2000s, it was in South Africa launched. So if you look at bonds which have been around for thousands of years, they're relatively new, but they are a unique asset class in that they're the only asset which can guarantee you a real return. So in this case, this shows the real yield on inflation-linked bonds, and that's the real return that you're guaranteed to get over the lifetime of the bond. And that, if you look at these charts in the 5 and 10-year space, you can see that's gotten to around 5% real, which we haven't seen since the early 2000s, more than 20 years ago. So we definitely think that the market has given us an opportunity to lock in a very attractive real return. And when in the stable fund and multi-asset funds in general, we have these CPI plus benchmarks. And when you can have a component of the fund where you know that it's guaranteed to deliver that real return, unlike other asset classes where it's all an assumption. You can buy a 10-year bond in SA for 9%, but the real return will be dependent on what inflation turns out at. Equities, we use long-term type of expectations and tilt for value, but inflation-linked bonds are unique in that ability, and that's why we value them so highly. And when the market gives you them at attractive levels of a real of 5%, we definitely think it's an important component to add into the portfolio, and we have been increasing that systematically.
I mean, if I look at kind of the 5-year numbers on your chart here, what's in March 2013 was a taper tantrum. I mean, pricing is so much better now, hey, compared to back then. It's much more attractive now.
So much more. So I think that's a reason, one of the reasons the market's giving you this opportunity, because there's a lot of negative sentiment towards these, because 10 years ago, the real yield was so low. It was negative in the 5-year area, less than 1%, and it's just gone up consistently. So it was overvalued at that point. There's technical reasons around LDI fund implementations, which were happening at that time, which drove them to unattractive levels, and we didn't hold them at that point. But now that the market has re-rated, people are still not a little bit pessimistic on it, and we do think that's creating the opportunity.
And Rashaad, something else I want to ask you about, because you mentioned about kind of a guaranteed inflation-beating return versus other asset classes and some of the assumptions you have to make. So how do you kind of assess the relative value of ILBs versus, let's say, nominal bonds, for example?
I think that's critical, because you obviously have to trade off a guaranteed real return versus an uncertain nominal return. And that trade-off is simply the break-even. It's the nominal yield minus the real yield, which gives you your break-even. And what that number defines is how much inflation do you need over that horizon in order to break even between the two bonds. So if you look at the left-hand side, the 2029 bond, the break-even sitting at just under 3.5%. That means that you need, if you're buying a nominal bond now, you need inflation below 3.5% average over the next 4 years in order for that nominal bond to outperform. If inflation averages above 3.5, the inflation-linked bond is going to do better. And I think what that tells you is that the market has really bought into this new inflation target that the SARB has been pushing through over the course of this year. And we think that's a little bit premature. South Africa's structurally inflation has been substantially higher than the new 3% target. It's a very aggressive to move from the midpoint 4.5 down to 3%, while the global inflation environment remains quite sticky. We do have a debt problem where you have debt to GDP at elevated levels. If inflation is low and you've got no growth, that's going to cause a problem. And when you look at the combination of the municipal charges, all the standard tariff increases that you're seeing, they're all well above 3%. And wage settlements that we've seen in the last few months have all been at the 7 and 8% level. Inflation got we're still in double digits. NERSA gave Eskom an extra 3% per annum for the next few years. So all these are significant challenges to getting inflation down to 3%. And we think that if the SARB does push this through, it's going to have a difficult task into next year once inflation starts moving up cyclically.
Yeah, talking about inflation, let's bring the conversation back to gold, something which you alluded to earlier, some position you've held in the portfolio for a long time, just gone through $4,000. As I said, Goldman is kind of aiming for almost $5,000. What's your take on it now at the moment, please?
Yeah, so we've liked gold as an asset class as a long time. In a multi-asset portfolio, it performs a unique role in that it's a type of asset which is a great risk-off hedge, and it can perform when other components of your fund are not doing well. And it's a very good long-term inflation hedge. Now, in the last 2 years, we've seen not only it being we've seen it being a massive return driver as well, for two reasons, which we have been highlighting. Firstly, geopolitical risk and the move away from the dollar. You're seeing the US, the confiscation of Russian assets was the big watershed moment, but also the more aggressive conflict with China, which is even bubbling up again in the last few days. And that geopolitical tension, both with hot wars and cold wars, definitely pushes people away from the dollar. And that move has been, gold's definitely been a beneficiary of that. The second driver, which we have been highlighting, is that the spending problem that we're seeing all across the world, is including developed markets. So you saw spending ramp up during COVID, and it's being very difficult for them to rein that spending in. And you've got structural deficits now. It reminds me of South Africa in the 2010s when President Zuma ramped up spending. We've never really been able to bring it back under control again. And all over the world, you look at what's happening recently in France and the UK's budget coming up. The US is the prime example where you've got a close to 2 trillion deficit. So these are significant issues. And I think the market's waking up to the fact that if the governments are going to overspend the way they have, then gold is a great alternative asset as opposed to the fiat currencies.
I mean, yeah, given all this noise that we're seeing in markets, I mean, probably it really is true that diversification is the only free lunch that you get in investing. And maybe to come back to something you alluded to as well about how diversified the portfolio is. So how's your team thinking about the portfolio positioning at the moment, please? Because I know you very much have kind of a safety first approach and then capital growth. So yeah, given everything going on, how are you thinking about that?
Yeah, I think the benefits of diversification have definitely shown through in the long-term performance of the fund and the ability to protect capital. And I think where we are now, you alluded earlier, it is a difficult environment. There's a lot of uncertainties. Even just recent days, the trade wars are kind of escalating again, and they might die down. But the situation globally has fundamentally shifted, and we have to be focused on capital preservation. When you look at the fund, we're trying to generate CPI plus returns, and when you see 41% of the fund, it is in equities. It's slightly above the 40% level now because of market movements, and we will bring that in time, but it is around close to the maximum level. But if you look at the holdings of our different equities, we've got almost an equal split between South Africa, Asia, Europe, and the US. So the US is a big part of the global market at the moment, but we definitely think that it makes more sense to have a balance across the world, and you have maybe more exposure towards some of the cheaper markets out there, like, for example, Asian equities. On the fixed income side, we've talked about inflation linkers, and you can see with that 15% allocation in South African inflation linkers, we have been pushing more into this where we can get a guaranteed real yield in a market where there's a lot of excitement, and we think the prematurely excitement about how South Africa is going to be at a 3% inflation over the next few years. We think it's unlikely, and we do still have a component of bonds, but we have been moving more into inflation linkers, and then money market, where we are getting still decent yields, inflation plus yields, and that gives us good optionality. On the global fixed income side, we've got a smaller component to foreign ILBs, that's TIPS out of the US. Our foreign bonds, we've got a little bit between the 5 and 10-year area, nothing longer than that, but the majority is in 0 to 5 year, as well as money market, which also gives us that optionality where we can deploy capital if there's a risk-off event. We're very cautious on credit as well as longer bonds because there's not much risk being priced in both of those asset classes. On the property side, also a good long-term inflation plus return. We've got 3% in SA property as well as 2% in foreign. And then gold is at around 7%, also playing a critical role, both delivering good performance, but also that diversification benefit. So overall, I think a great mix of different asset classes with the ability to deliver that inflation plus return, and individually as well as a combined diversification component to protect capital in difficult environments.
On that point, I mean, I really do like how you've spread out kind of your equity exposure across different regions as well. It definitely makes it a much more safer, conservative portfolio, especially in this kind of environment. Yeah. So Rashaad, I guess just the last question for today then, if you can just please summarize kind of everything we've spoken about, what are the key takeaways for our listeners in today?
Yeah, so you've mentioned we've had a strong year in asset classes, but we do think we are still in a somewhat difficult environment. Inflation is cyclically low, but you are seeing sticky inflation globally, and we do think that the pressures will build into next year. US asset prices are elevated, but I think that the combination of the trade war as well as falling immigration has a combined effect, a negative effect, both on growth, bringing growth down, as well as keeping inflation sticky. So it is going to be a more difficult environment in the US, and globally, political, geopolitical, it's always in the news and things are popping up constantly. So those risks are going to remain elevated on a structural basis. Coming to South Africa, I think the hopes of getting up to 2% growth have faded. We're still struggling to generate growth, and I think things have settled, so we are a little bit calmer politically. But I think going into the middle towards the end of next year, as the market begins to look towards the ANC elective conference in 2027, I think that the risks will begin to build. And South African bonds, we've had a very strong rally, but with the 10-year moving, even dipping to 9% and below, we do think a lot of that value is priced out. It's going to be very difficult for them to deliver the same returns over the next 12 months as they have delivered. So that's the reason why we are switching more into inflation linkers, especially in the 0 to 5 year area. Gold we do like for its diversification and return benefits. And we think overall, when you look at the previous slide in terms of the structure of the portfolio and the diversification across different return drivers, we're very happy with the positioning at the moment, with the ability to deliver the return target as well as to protect capital.
Rashaad, brilliant. Thank you very much. Always great chatting to you.
Thanks, Anil.